You don't need to be rich or live in America to be able to invest in the US stock market. In this video, I'll break down the US stock market into ways that you will be able to understand, and by the end, you should know if you want to invest or not. I started investing in the US stock market last year, and I wish I started many years ago. For example, if I invested this amount in the total US stock market 5 years ago, I would have got this. What's up, guys? If you are living in Africa and you want to understand how the US stock market works, you've come to the right place. I'm going to break it down in simple English, and by the end of this video, you will gain basic understanding about this market. Welcome to my channel. Subscribe, like, and check out my finance playlist if you want videos about finance. Let's get started. Now, what is the US stock market? Basically, it's like a marketplace. In a marketplace, you may get foodstuffs, vegetables, fruits, or you may get clothes, shoes. But in this market, you are getting pieces of companies. And these pieces of companies are called stocks or shares. Now you may wonder, why on earth would companies want to sell parts on themselves? Why don't they just develop on their own and try to make it and grow? Well, the answer is simple. If you want to grow at a fast rate, you need investment coming in. You cannot do that level on your own. For example, if you take a loan from a bank, you will pay back with interest. If you do it on your own, the rate of your growth will not be as fast. But when you get money coming in as an investment, you'll be able to grow, you'll be able to hire more people, build more products, offer more services, try more experiments. And this is why most companies offer shares. So when you buy a stock or a share, you are known as a shareholder. You may wonder, what does it mean if you buy a stock? Well, basically, you own a tiny part of that company. Another question you may ask is, how do people make money from the US stock market? And there are two ways. One is price growth or capital gains. This means if you buy a stock for a price and the value goes up in 6 months or a year and you sell it for a higher price, you make a profit. That's how you make money. For example, if I buy Nvidia for $100 today, it doesn't buy a full share, it buys parts, but you can do that. And in a year's time, that $100 is now worth $150. And I decided to share, I have made a $50 profit. That's capital gains, that's price appreciation. Now the second way of making money is through dividends. There are many companies in the US that pay dividends. What this means is that they share a part of their profits with their shareholders. So take this for believing in us, investing in us. And dividend paying companies are different from companies that focus on growth, because when you pay dividends, you cannot reinvest that money into the company for growth. Growth companies prefer to reinvest the money instead of giving it to shareholders, giving parts. So dividend paying companies give something small to the shareholders that take, thank you for believing in us. So those are the two ways of making money through the stock market. You may wonder, what causes price changes in the US stock market? Well, there are three things that cause price changes. One is the company performance. If the company does well, it's very likely that the value goes up and your price or your share price will go up in time. Two is supply and demand, basic economics. If a lot of people buy a stock, the price will go up, because the higher the demand, the higher the price. At the same time, if a lot of people sell the stock at the same time, the price or the value goes down. So that's another factor. So it's not always that the best companies increase the fastest. For example, GameStop. You can research the GameStop incident. And let's go to number 3, big economic events. So if there's a pandemic or there's war, prices crash like crazy. Prices are affected. So any major global events, even Trump talking about Greenland and NATO, caused people to fear, and they're selling some of their shares. So these things cause price changes in the US stock market. Now, you can't talk about stocks without talking about ETFs. ETFs and stocks go together. Now, what are ETFs? Well, ETF stands for Exchange Traded Funds. Basically, they are packages that have lots of stocks in them. I like to say a basket. So if you buy one ETF, you could have a little bit of Nvidia, Tesla, Apple, Microsoft, Meta, Amazon, Google, and a lot of other companies in there. So they share whatever the price of the ETF is into tiny percentages, maybe 5% to Nvidia, 2% to Tesla, 3% to Google. That's how ETFs are. And many investment leaders say ETFs are much safer than stocks, and I 100% believe in that, because you are diversifying your risk. More times people think picking stocks is easy. It isn't. You may think that, oh, Nike is a great company, let me pick Nike and invest in. And when you check the record of Nike, the growth, you realize that it's not as much as you want it to be. So each ETF is there for a purpose, and there are thousands. There are so many ETFs out there, and each of them have a purpose. So now I'm about to talk about 5 types of ETFs. First is a market-wide ETF. These ETFs focus on markets as a whole. For example, there's an ETF that tracks the entire US stock market. So if you buy or pay for that ETF, you will get exposure to every single stock in the United States. There's an ETF that covers the whole world, a global ETF. There's an ETF that covers the largest 500 companies in the United States. There's an ETF that focuses on the China market, ETF that focuses on the India market, ETF that focuses just on Europe. There's even an ETF that focuses on all companies in the world apart from the US. So all these have different data, growth rates, history. So it requires some research if you want to pick one, but most investors recommend that you have a market ETF in your portfolio because the risk is extremely diversified. If, for example, you buy the entire US stock market, if America is doing well, you get more money. That's basically it, instead of just picking a company and likes. The second type of ETF is sector ETFs. These ETFs focus on sectors. For example, technology, healthcare, finance, utilities, semiconductors, AI, cybersecurity. Any sector, these ETFs focus solely on that sector. For example, for tech, there's VGT. It only has tech companies in there. So if you believe that, okay, I believe in US tech companies, this is what I'm going to invest in. There are ETFs that focus only on finance companies. If you believe that, okay, finance companies are reliable, you can pick those ETFs. So that's sector ETFs. Now let's go to number 3, the third type of ETF, dividend ETFs. I talked about dividend stocks. So dividend ETFs focus on companies that pay dividends or have a great history of paying dividends. So the most popular one is SCHD. It has companies that pay dividends, and currently it has a dividend yield of about 3.83% every year. That's what you get for investing in it, and the price also appreciates. So it's not only dividends, the price also appreciates. That's why people love dividend stocks. But point to note, for those who are not living in the US, you will pay a 30% tax on every single dividend you make. So if you get $100 dividends, you are going to only get 70%. If you're in Europe, Africa, Asia, wherever, that's it. That is the law. Now the fourth type of ETF is growth ETF. These ETFs focus on companies that are incredibly focused on growth. And these companies are likely to be in the tech industry, but they focus on growth. So they pick the companies that grow quickly. So I want to be Nvidia, TSM, Google, Amazon, like companies that are heavily focused on growing, and these ETFs pick them. And the fifth type of ETF is value ETFs. These ETFs focus on companies that are reliable, solid, good fundamentals, very good companies. Now, because these are valuable, it's not really going to focus on companies that focus on growth, because growth companies can get volatile in the market. 1 second they grow by 10%, a few weeks later they are down by 10%. But value focuses on very stable companies, so the growth is much more stable. It's considered as a defensive position in a portfolio if you do that. Now for bonus, you can say momentum ETFs like SPMO, they focus on making changes and picking the companies that are growing the fastest. So that's a bonus ETF. And in my personal interactive brokers portfolio, I have at least an ETF from each of these 5, plus SPMO as well. So it has served me well at the moment. Now you may wonder, who creates these ETFs? Who is responsible for ETFs? ETFs don't appear magically. They are created by large financial institutions. Some of these institutions are Vanguard, Charles Schwab, BlackRock, State Street. These handle the ETFs and they charge a little fee for handling it. Good news is that since ETFs are not actively managed, the fees are very low. For example, Vanguard's S&P 500 ETF, which is ticker symbol VOO, it charges just 0.03% to run. In other words, if you pay $10,000 in that ETF, you just pay them $3 that, hey, take $3 for managing that portfolio. So ETF costs are very low compared to actively managed funds. You get 0.03, 0.06, 0.15, 0.2, 0.3. You rarely get any ETF above 1%. And these companies are very reliable. They manage trillions of dollars for investors worldwide in decades. So your money is very, very safe. Why do majority of people say ETFs are more recommended than stocks? Well, these are 5 reasons why. First, lower risk than single stocks. Like I mentioned earlier, investing in a single stock can be a bit risky because you cannot tell the future. But if you invest in ETFs that have a couple of stocks together, it balances the risk. One company does well, another company doesn't do so well. Overall, you are more likely to get a positive return since you are investing in solid companies. 2, ETFs are easy to understand. For example, if you want to invest in stocks, you have to do research. What is the moat? What is the company's history? How much are they earning? What is their profit margin? This is for ETFs. You know, okay, I don't need to understand what all these companies do. I know that this is the sector that is invested in, and I know these companies are solid companies. I don't need to really go into them. Let's trust the process. So it's very easy to understand. 3, they're automatically diversified. So I don't need to explain that. Instead of picking one, you have a huge range of options. Sometimes there are stocks that you don't even know are doing great in a day, 10%. But if it's an ETF, you are likely to catch that. But if you are doing individual picks, you are not likely to catch that unicorn company. 4, less emotional stress. Believe me, if you are a stock market investor, you will get stressed when the market crashes, and the market will crash. It's never perfect all the time. There are years where you will make losses. So ETFs cushion those losses better than when you pick an individual stock. And also ETFs are great for long-term investing. You don't need to look every day and see, hey, what's this? Is this going up? Is this going down? You can just calm down. Every month or every 6 months, you check what's going on, and you don't need to stress yourself too much. So now you've seen stocks, you've seen ETFs, and to invest in these, you need to join a broker. And the main broker for Africans is Bamboo. That's like the only one that I've seen readily available for Ghanaians, Nigerians. I don't see many. But my favorite and the broker that I use is, like I mentioned earlier, Interactive Brokers. Because free deposits between Wise accounts and Interactive Brokers, free withdrawals as well. The fees is just 0.35 per purchase of a stock, while Bamboo is $1 per purchase. So, and other factors as well. But I'll create videos about Bamboo and Interactive Brokers very soon. There are basically two types of markets in the US stock market. There's the bull market and there's the bear market. The bull horns going up means that the market is good, companies are growing, things are great. Bear markets means the opposite. Companies are falling down, prices are going down, and things get difficult. You can never have a bull market forever. You can never have a bear market forever. These two work hand in hand to rebalance the economy. So in bull markets, this is what you are likely to see. Prices rising, people are optimistic, people feel like their investment grows because they can report high returns and easy money. That's what happens when there's a bull market. Examples of a bull market have been between 2013 to about 2018. It's been consistent growth. Another example was quickly after COVID to about 2024. So in those times, the market was great. It was a great time to invest. You invest, your money will go up in 6 months' time. Everything is great. This is what happens in a bear market. Prices fall, people panic, people are sad, and people quit investing altogether. That's what happens. There's a lot of negative news, lots of headlines. That's what happens in a bear market. Examples: the 2000-2002 dot-com crash. Heavy losses people made. Some took about 10 years to recover from those losses. There's a 2008 crash as well. COVID-19 crash as well. These are moments where your investment could lose 10, 20, 30% of value in a year or in a few months. And you can never have a market without these. You experience these in time. That's just nature. If you check the history of the stock market, these crashes have been there. So just so you know. One tip is, when the market crashes, smart investors consider that as a discount on all stocks. For example, if Google stock was $200 and the market crashes and now it's just $100, smart investors will buy more $100 stocks of Google. So if in 2-3 years time it recovers, then they got that for a discount. So that's why it's good to have something that's bringing in money. So whenever these crashes happen, then invest more. Me personally, when prices go down, I buy more, because I know that over a long period of time, the stock market always goes up. There's a silver lining in every dark cloud. But these are things you must do to make sure you get the most out of the stock market. Don't invest money that you need urgently, because the worst position you can find yourself in is you invest what you need in a few months' time, and then when you need it, the price has gone down. So now you have to sell at a loss. So that is why you shouldn't invest money that you need urgently in the year or 6 months. Don't chase quick profits, because that is day trading. oh, I bought this and now the price has gone up 10%, let me sell. What if the price goes up again? Then you sold when you could have made more money. So don't chase quick profits. Also, invest in the long term. Time in the market is better than timing the market. Don't invest only, oh, okay, prices are going down, I'll invest now. You cannot predict the market. You may think that price has gone down, so you're investing. It may go down. Then you are in trouble. So the longer you are in the market, the more money you are making. Those who started investing earlier have made much more than those who are new in this. Also, don't just copy anyone. If you are in this investment bubble, you see so many YouTube channels of people giving advice. This stock is hot, this stock will grow, this, that. It's good to watch, but do your own due diligence, research, and be sure about what you pick before you pick. Because at the end, it's your own money. It's not their money, it's your money. So you have to make a decision for yourself. So what you need to start investing, like I mentioned before, you need to join a brokerage and you need to find a way to fund your account. Bamboo allows Momo funding, card funding, interactive brokers. You need to use the bank to fund your interactive brokers account. So we've come to the end of the video. I hope I've explained this well enough. And thank you if you've made it this far. I'm very grateful. More videos about investments will be coming. ETFs, investment brokers. So more content is cooking, and I'm very excited about this because I am undertaking this journey. So thank you for making it this far. I am Rick. See you on the next one. Peace.